Welcome back to the deep dive. So you've given us these sources looking into the UK housing market and specifically how this upcoming autumn budget seems to be casting a bit of a shadow.
It really is, and the tension is quite clear, especially when you look at the Acadata data.
Yeah.
Now, they focus on completed sales, which is, the solid metric.
Right, the actual deals done.
Exactly.
Yeah.
And it confirms the market is, well, pretty constrained right now.
Okay, let's unpack this a bit. Acadata is showing an annual decline for September of 3%. Now, 3% might not sound like the sky is falling, but the sources are really stressing this point. It's the weakest year-on-year figure we've seen for quite a while, a real shift in mood.
Definitely.
So our mission here is to figure out, okay, what forces are driving this sort of short-term dip, this nervousness, versus what's still propping the market up long-term?
Let's start with the numbers then. The average sale price in England and Wales, it's sitting just over £355,000. That was basically flat from August,
Okay.
but confirms that 3% drop compared to last year.
So why the stagnation? Why this paralysis almost?
Well, the analysts point to a few things hitting all at once. There's the general economic uncertainty, concerns about jobs,
Sure.
speculation around taxes in the November budget. That's definitely playing a part. But probably the biggest immediate thing is refinancing.
Ah, the mortgage cliff edge we keep hearing about.
Exactly. You've got loads of borrowers whose cheap fixed rates are ending. They're facing much, much higher payments.
Which forces some sales, I imagine, and just generally makes buyers nervous.
Absolutely crushes buyer confidence. And consumer confidence overall is, well, it's still pretty fragile.
What's interesting, though, is that actual transaction volumes, the number of sales, they seem to have stabilized.
Yeah, the sources suggest that. It looks like the market's finally kind of digested those earlier distortions for the stamp duty holiday ending.
Okay.
Activity seems to be back to more typical seasonal levels.
So volumes are okay, relatively speaking, but prices are slipping. Why isn't that steady activity putting a floor under the prices?
Well, this is where it gets interesting. We're seeing this kind of supply paradox.
Paradox. How so?
Because on one hand, you've got landlords feeling the pinch from higher rates, maybe regulatory changes too, selling off properties.
Right, adding more supply to the market.
Which should and does put some downward pressure on prices right now.
But,
and this is what's fascinating, the sources are really clear. Despite those landlords selling, the long-term picture is still dominated by a huge structural shortfall in housing.
right, that underlying lack of supply hasn't gone away. They estimate, 2 to 3 million households waiting?
Yeah, latent demand. People waiting in the wings to buy a herd, it's massive.
So the market's like a pressure cooker, basically, built up over years of not enough building.
Precisely. And high interest rates are just kind of keeping the lid clamped down for now.
Hold on, though. If there are 2 or 3 million households desperate to buy, why is the annual fall only 3%? Shouldn't that massive demand be, pushing prices up or at least stopping them falling?
It really comes down to affordability, doesn't it? That latent demand is huge, but it just can't translate into actual buying power with borrowing costs where they are.
Makes sense. And does this play out differently across regions?
It does. The price declines are pretty widespread, but they're led by places like the Southeast, the commuter belt areas. They tend to be more sensitive to interest rate changes.
Okay.
London, interestingly, was the exception. It actually recorded a small annual increase.
Really? Why London?
It suggests maybe the higher end of the market there, perhaps less reliant on mortgage debt, is just less affected by the Bank of England's rate hikes compared to the rest of the country.
Which brings us right back to policy, doesn't it? The budget lever.
Absolutely. With all that demand sitting there, frozen, any measures in the budget designed to stimulate housing, well, they could potentially unlock that demand quite quickly.
Turn potential demand into actual market activity. That could shift things fast.
It could, but, we need to keep expectations in check a bit. Acadata also points out that the market's not really expecting many more interest rate cuts from the Bank of England this year.
Okay. So even if the chancellor tries to boost things?
That lack of relief on the borrowing cost side might limit how strong any rebound could be.
Right. So wrapping this up, what's the overall picture then? It feels like the market's currently stuck, driven by these short-term worries, refinancing stress, landlords selling.
Immediate pressures.
But the fundamental deep-seated problem, this huge structural undersupply that hasn't changed at all.
Exactly. And that leaves us with a really important question, doesn't it?
Which is?
Well, if that underlying shortage is so big, millions waiting to buy, just how much stimulus would the chancellor actually need to put into the budget to completely counteract these current pressures? The landlord selling, the higher for longer rates outlook.
Yeah, how much policy firepower does it take to overcome a multi-decade housing deficit? It really highlights the potential limits of short-term fixes, doesn't it?
It certainly does. That's the balancing act everyone will be watching.
Indeed. A lot to think about there.